Vegan Roundtable January edition. And Mark, anytime you're ready, go ahead and press the button and let's get this thing underway.
All right, we are underway. All right, well, welcome everybody to the January 2021, making sure we write the right year on our checks these days. What, does anybody still use checks? Anyhow, welcome to 2021, and this is one of our continuing series of webcasts that we've been doing on a monthly basis since July 2010. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, one of the sponsors of this monthly incursion into excellence in investing. We've been having a lot of fun over the last 10 plus years, and we'll continue that tradition tonight. We're joined here tonight by Kim Butcher of Florida. Kim is a lifelong investor, also a labor and delivery nurse in her professional career. She is hiding from the snow in Florida. Say good evening, Kim.
Well, good evening, all. And it's lovely when it's nice and warm here.
I heard 80s earlier today. That's pretty attractive. And he was actually taking time out from his extremely busy schedule. For those of you who don't know, he was a pharmaceutical scientist and a very active investor, not a trader. You've heard us saying some crazy stuff here for the last few minutes in the green room. We do tinker every once in a while so we understand things better, but he was a long-time committed, long-term investor. Welcome, Hugh.
Hey, thank you.
And last but not least, we're joined by my dear colleague, a few miles to the north, getting a little bit more snow tonight and this afternoon than we did here. Ken Kavula, nationally renowned educator for better investing, and just
hi, everybody.
A good friend and small company champion all around. All right, so let's go ahead and get underway. And by the way, Ken, you know, you keep shutting me down on these excursions into Punxsutawney. The fact that it's here on the cover page does not absolve you of that requirement that we got to get there someday.
Okay.
We will do that. All right, let's get the legal paperwork out of the way. No investment recommendation is intended. This presentation is entirely an educational demonstration. It is meant to illustrate the methods, techniques, philosophies of the modern investment club movement as taught by NAIC, the National Association of Investors / Better Investing, or as interpreted and championed by Manifest Investing. We're all out there looking for better companies at better prices, rinse, repeat. The opinions that we express are our own. If we own shares of a company that we're talking about, we will try to remember to make you aware of that. If you'd like future reminders for these monthly webcasts, you can send an email to nkabula1@comcast.net. He will not inundate you with emails. She'll just simply remind you when these are happening. We do most of them on the final Tuesday of every month at 8:30 Eastern Time. If you'd like a copy of the slides, or if you have follow-up questions, mark@manifestinvesting.com is my email address. So let's go ahead and get underway. Here is kind of our standing agenda. It's been kind of this way for 10 years or so. We do welcome any newcomers. We keep it fairly informal. We do monitor for questions in the questions tab, and if you are equipped with a microphone, we stick around for a Q&A session afterwards, and we encourage that type of exchange. We do keep track of how well we do. We will be talking about our performance results here in a minute. In the context of when to sell and portfolio management, we'll talk about our hot seat stocks tonight. You can see the presentations on DR Horton, S&P Global, actually morphed into installed business products, IBP there. I'm going to go ahead and come with Alimentation Couche-Tard, which is a repeat selection that Ken had brought a little while back. And Hugh, I don't think did you want to throw another log on the fire tonight, or just leave it as TBD for now?
Well, I didn't have time to do anything today. I was going to look at BP again, but
yeah,
the price has gone way up, and the dividend yield is really low at 7.5%.
And what was the company again?
It was BP.
Oh, BP. Okay.
Yeah,
Yeah, that one's been chugging along. We're going to take a look at that.
I know. Badly.
All right. If there is time for discussion at the end, we will do that. We do leave the floor open for open Q&A. And as it says there, third bullet from the bottom, we do conduct an audience poll based on the audience presentations. Or, excuse me, the stock presentations, and the audience is encouraged to vote. Just a quick summary of what we've been doing these many months over the last several years. We do keep track. We keep track of the performance of the portfolio. Our objective is to beat the Wilshire 5000 by 5 percentage points over the long term. And until very recently, we had been doing that quite handsomely. We'd also like to see over half of our selections outperform the total stock market index also over time. Here's our timeout for an educational moment. We don't need to spend a lot of time talking about this other than just to raise the awareness that there's some pretty chaotic stuff going on in the stock market these days. Long story short, there's a group of socially connected smaller investors on the Reddit site. We talked about it at the bull session this afternoon a little bit. We are probably going to continue to kick this around. Jim Cramer's been doing quite a bit on CNBC on the subject. I know that GameStop itself was like $30 a share a couple mornings ago, and it has obviously been quite the rocket the last several days. You can see even today it went up 93% during the day, and then after hours another 43%. So it is now actually after hours above $200 a share. Just an unreal situation. Ken, your thoughts on what we've kicked around so far?
Well, like I said in the bull session this afternoon, I'm not sure this is healthy for the market in the long term, but I can't help but have a little bit of a feeling of we won finally. Institutional investors, in my opinion, have been made to follow the big guys for the last 20 years, and we haven't been able to impact the market any real way. These guys on Reddit have found a way at least to attack some of the short sellers, and that's a start. I really do think that they've thrown these big guys in some of these hedge funds for a loop, and they're having a very difficult time figuring out how to combat what's going on. Maybe part of the combat will have to be that you don't spend millions of dollars shorting a stock. Maybe that'll be part of it. I don't know. I don't think it's good for the market. I think that there are a number of stocks that this is happening on, not just GameStop. But I do think, Mark, it's something that we need to discuss and understand, and then make our community aware of so they don't get caught in the middle of something.
Yeah, absolutely. And
I guess my biggest fear, Mark, is to open up the Better Investing website and look at that list of the best moving stocks in the last week, the fastest moving, through sales and purchases, and to see one of these stocks appear on that list. That would really create a dilemma for me if I saw clubs beginning to get involved in some of this stuff right now.
Yeah, I'm not sure how a club would, with the monthly program, even with the internet, how it would operate in that mode. But I'll tell you, it's pretty wild. One of the first things I checked was the groundhog standings to see if any of the groundhog participants had GameStop in their portfolios, and the answer is no, none for this year, anyhow. I don't know. It's an interesting topic. Kim or Hugh, any thoughts just in general from 35,000 feet on this one?
None from me. I didn't even know it was going on. I'm too secular in Fort Lauderdale. It's all about the family right now.
Mm-hmm.
Mark, Ben makes an interesting point. Maybe you can do 2 minutes on what we think is happening with GameStop right now. He says he imagines a lot of our audience isn't aware of what's going on, and they might like a brief explanation of what might be happening.
Okay, we can probably go a little bit deeper in the after session, but I can give you the nutshell version. late last week, and this is something that's been kind of percolating for quite some time. I'm sure that Sean can probably give a little more background on it, but what it amounts to is a group of people on Reddit, which is a social media site, kind of like Twitter, I guess would be a comparison. It's a little bit different than that, but it's a mailing list type thing. Anyhow, it's a platform for social media. And what they have done is they have identified a number of hedge funds who have been quite public about shorting stocks. Now, GameStop itself, if you actually do a stock selection guide or a stock study on the company, you basically come to the conclusion that this thing was probably on life support, perhaps headed for bankruptcy. I'm not sure how serious the situation was, but it was pretty bad. So there's a group of investors out there, institutional investors or rhinos, who will actually bet against a company like GameStop. Let's say that it was $50 a share, and they basically sold millions of shares. And then they have this, when you short a stock, you're basically selling something that you don't own. I know this is very unusual for most of us in the room here, because it's the exact opposite. It's completely 180 degrees from the way we normally think. You're selling something you don't own with the promise that you will buy it back in the future. Now, obviously, you hope that you buy it back at a lower price. And these professional investors are hoping that GameStop would go from 50 to 0. And they basically pocket that downdraft in stock price. Well, what happens is a bunch of people begin buying it, and they're doing it through this social media. They're actually naming off these stocks and going after. In fact, the professional firm is Citron Management, and they make very public the companies that they are betting against. And so anyhow, all of these investors are jumping in. Look at the price action on Monday, going from something down around 30-ish or 40-ish, up over $100 a share. So if you've sold that and you have to replace it, it's what's known as a short squeeze, because you have this promise that you have to keep. So as you might imagine, if this stock price were to go up to 400, 500, you could lose an awful lot of money. You can lose a lot more than your original stake in the situation. So these professional hedge funds are really taking some serious heat here. Just to give you some idea of the gravity of the situation, another professional investor in a hedge fund in Chicago had to actually provide $2 billion of personal funds to keep one of these short hedge funds in business and to try to wiggle their way out of this. And that we're talking about some fairly substantial stuff. So I doubt that if you did a stock analysis on GameStop, in our traditional sense, you could come anywhere near this company being worth $209.66. And it really is a case where the market price is being pushed around by spectacular waves of supply and demand action. So hopefully that helps you understand kind of what's going on. It's a fascinating situation, and it'd be interesting to take a look at, how's the SEC going to respond to this? And
Mark, there's another twist that people are reminding us of also, that you can't sell naked shorts. In other words, you actually have to own a share of stock that your broker will borrow from another account. And the Reddit folks are asking people to instruct their brokers not to allow them to borrow from their account, which evidently you can do. Well, that means the shorts become even more agitated in trying to find shares to back up what they want to do in the short, and then it just keeps pushing that price higher and higher and higher. How does it all end? Well, at some point, somebody gets left holding the bag because obviously this isn't worth $209 a share. But for the moment, I don't think anybody's had to learn that lesson yet.
Yeah, as somebody did point out, there were people who lost 50% of their position on Monday. Quote unquote amateur investors. So yeah, it's not insignificant. So interesting stuff. And again, it comes back to that supply and demand, as Ken just described it. Think of it, if that supply, the normal supply, is now constrained or interfered with in some way, as they appear to be doing. And again, it's not illegal. It's wild. It's simply wild. So it'll be something that we put together. Len Douglas had forwarded over a list of some of the companies that are involved. I mean, I know of people that have benefited greatly from some of the companies that have come under this situation in a much less grand scale. So anyhow, that's
Mark,
bring it to our attention.
we have a question from Victoria. She's raised her hand. I'm going to unmute her. Victoria, you're muted on your end. So if you unmute yourself, you can then speak. We're going to call that an inadvertent hand and take it down. Carol has her hand in the air. So Carol, you're unmuted. Go ahead. Carol Green. And we're going to call that another inadvertent hand, folks. Watch your hand. If you don't want it up, don't put it up. Sean's hand is up. So Sean, you're muted on your end. You'll have to unmute on your side.
Okay. Well, I've got a lot to say about this, so but I'll just keep it
let's
short.
try to keep it short, though.
Yep.
Okay. Yeah.
Understood. I apologize for constantly putting in the question stuff there, Ken. But no, this has been something absolutely crazy going on with Reddit, and there's several stocks that they have been really pushing hard for. But I think it's just a matter of being tired of hearing, oh well, J.P. Morgan just is putting a sell on stock A, so the stock immediately drops. Well, now they're flipping the board on them to say, well, you know what, we're going to decide on that. And so it's been a very interesting thing. I'm riding the wave right now, obviously not with any serious money, but I'm not going to be upset about making an extra $500 here. So
yeah, fair enough. I mean, I can sympathize with, it's well documented that when Goldman Sachs issues a recommendation, that it moves the stock price. And in fact, a subject we'll probably take up. I should point out that we have been discussing this sort of thing during our Tuesday afternoon bull sessions, and we'll talk more about that later. You can actually get the archived recordings, and we're going to be covering this topic in greater detail. But Kathy Wood down at ARK Investment Management, I mean, it's estimated that she can simply pick a stock, and the demand that follows her public disclosure on social media is good for at least a 5% bump on the stock. And that's not inconsequential to somebody in the business. So it's I'm with you, Sean. I think it's something we want to understand and certainly protect ourselves against it.
I'm going to take two more hands and then we're going to move on. Phyllis, you're unmuted. Go ahead. Phyllis Jackson, you're unmuted. That was an inadvertent hand. Al Johnston. Al, you're unmuted. Al, you'll have to unmute on your end. And another inadvertent hand. Yeah, okay, Mark, why don't you continue? All right.
Yeah, we didn't intend to spend quite so much time on it. We are going to cover it in greater detail, and it's just something that, again, as in the realm of investment education, just try to understand what's going on and what exposure you might have. And, as Sean said, if there's a way to take advantage of it, there's nothing wrong with that, but do so with an informed approach and be careful out there for sure. All right. Good thing we don't have any sell nominations to talk about, Ken. We just burned up all our time. Here's the performance of the Investing Roundtable since 2010. The chart that you're looking at tracks the relative return over time, and our objective is to stay above that red dotted line. We've dipped down below it a little bit. The rate of return since the inception of this portfolio, it's an annualized internal rate of return, is 18.5%. The Wilshire 5000 over that same time frame, if you did matching investments, would be 13.8. So the relative return is simply that first number, 18.5, minus 13.8 gives us a relative return of 4.7. So we're trying to stay in that 5 and above range, and we'll just keep our fingers crossed. The track record's pretty strong, and we basically raise glasses and do an ice cream toast or whatever we want to do every time we see this. We're grateful, and we do come here and just share our single best ideas on stocks that can be studied. And this is basically telling you that the suggestions have been pretty good over the years. They don't all work out. There are no guarantees in this business. We do have an outperformance accuracy a little over 50%. And we do actually have a positive net cash flow on the money that's been taken out of those selections over 10 years. Fun fact for you: right now there's 200 open positions in the roundtable tracking portfolio. 194 of them are positive. 194 of them are positive. That's a fun one. All right. A couple months ago, we decided to split the roundtable tracking portfolio into two components, a core component and a non-core component. This was modeled after some work and the words of George Nicholson in the 1984 Investor's Manual, where he basically gives us permission. The gods of investing, the modern investment club movement, give us the permission to have some non-core investments. Now, up, straight, and parallel is important, and we will try to keep 75 to 80% of our portfolio on the left-hand side of this ledger, but it is okay to buy some early life cycle companies. Amazon and Tesla come to mind, companies that have little or no track record, turnarounds, et cetera, et cetera. It is okay. The investment club that we dealt with here in Michigan was actually a 40-year investment club, and they were in the process of disbanding because some of their partners wanted to do some non-core investing. We advised them that they could. They could basically split into two components. The really neat thing is that crime scene tape is not fiction. That is the first meeting that we attended after they'd been doing it for a couple months. They actually had crime scene tape down the middle of their dining room, and with partners assigned to each side of the crime scene tape. Good, clean fun. Here's what the situation looks like right now. Again, the traditional roundtable tracking portfolio, we basically renamed that core. That's approximately $400,000 worth of stocks with the characteristics that you see there. The non-core is about 15% of the sum, and you can see how the two kind of go. Ken, would you like to comment on how these kind of shake out?
I'm answering lots of questions here, Mark. Sure. I think that the core is exactly where you expect it to be. The par is a little bit low right now, although it's only within 0.9% of the sweet spot, so it doesn't need much fiddling around to get up to the sweet spot, which is at 10.6 up there. Quality is where I would expect it to be. Earning stability, financial strength, where I would expect it to be. The growth is just a touch light. I might like to see it at 11.5, maybe even approaching 12%. But for the most part, the core is exactly where I would like to have it. And if we're going to do anything, I would focus a little bit on growth, a little bit on par. The non-core is doing exactly what I would expect as well. Not as nearly the kind of earnings stability we would see in core stocks, not nearly the financial strength. We're looking at younger companies. We're looking at turnarounds. We're looking at companies that perhaps haven't had earnings recently, so that that brings these numbers down considerably. And when these numbers are lower, the quality is also lower then. So I'm not concerned by that low quality as long as the composite quality of the portfolio, and that's the numbers at the very bottom, are still above 80, and they are, and so I feel real good about that. I also feel real good about the growth in the entire portfolio. We worked hard, folks, to move our growth. About a year ago, we had noticed that growth had sunk to under 10. In fact, there were a couple months when it was approaching 9 pretty quickly. and we worked hard to push that growth back up so that it was somewhere around 11.5 or 12%. Overall, I think the two pieces are performing as we expect them to. Even the PE values, I would expect non-core PEs probably to be moving all around with all the COVID stuff going on and all of the issues of where are we going next? You know, when does a stock turn around if it really fell off of a cliff in March? When does it start growing again and getting back to trend? All those kind of things. So I don't see anything that would worry me about the two sections at this particular time.
Okay, well, let's go ahead and keep cranking away. Here's the actual top 20 holdings in the core side of the portfolio. There's a few more that are off the page. You can actually see the entire portfolio if you go to that public link right at the top there. To decode this page, again, I'll just do this very quickly. Anytime that a knight, a damsel like Kim, or the audience selects a stock, we invest $1,000 into it. So in the case of Microsoft has been selected 5 times. So $5,000 has been invested in Microsoft. It is now worth $58,900. So that's how you break down that code. How many times stocks have been selected? I'm going to be bringing Alimentation Couche-Tard tonight. That's been selected twice, and it's not quite on the chart yet. After my selection tonight, along with the audience vote, it'll be up to 4 positions. A little bit of lobbying there, and perhaps make this list in the future. So this is the top 20. Again, you can see the whole list by going to it. The non-core part of the portfolio is in this sub-portfolio. Again, the link is right here, just tacking on the word non-core. And you can see, again, a little more erratic, a little more youth in terms of company life cycles. And those are the companies, many of them doing quite well. I mean, Amazon is a 2-time selection. Right.
Mark, Jacques has made a point for us right here, and perhaps we can do something to help him out in the next couple of months. Jacques, we've just begun this split into core and non-core to demonstrate some of the things that we've been talking about for years. He wants to know, do you have a measurement of how the core has performed versus the non-core? And I think that as we move into the future, we'll be able to get you those performance numbers. But for now, like I said, it's only been, I think, 2 months where we've actually done the split. So I don't think our data would be real reliable at this particular time.
That's an interesting question, though. I could maybe do some playing around when in my free time.
Oh.
All right, let's keep going. All right, we don't have anything to sell tonight. Maybe one. In the core side of the portfolio, the companies that have the lowest return forecasts and are on the hot seat are EPAM, Illumina, and Cerner. And none of these are worth worrying about in the context of core holdings. Again, we like to think about selling core holdings if the portfolio needs it, first of all, and it doesn't need it in any sort of an emergency. And second, if those would actually approach money market rates, and that's not the case yet. So I say we just, I'm basically suggesting we just move on. We also do take a look at companies that are eligible for what we think of as almost like a timeout. We finally do have a few companies that qualify for this list. I do think we should probably wait and see what happens with VMware. Sai's unable to join us here tonight. The problem at VMware is their top dog left and took over Intel. The new chief executive at Intel is the guy that used to be at VMware. And so there's a management upheaval in progress. So maybe we just kind of see what goes on there. United Airlines, there's a number of positions. I think we leave that one alone and give it the non-core exception. And since I'm adding alimentation, I think we kind of let that one go. Now, Employers Holdings, even though it's up since the time of selection, 13%, the market's gone up almost 40%, so it's trailing. And it's a workman comp related company. I I'm certainly not attached to it in any way. I think we just
Mark, I'll go one step further on Employees Holdings. It's a workman comp related company, almost entirely dealing with the restaurant industry.
Yes, it is.
So it just couldn't be slammed harder on the head by COVID than this particular company right now.
Yeah, and frankly, I think they've managed well, but
Absolutely, yeah.
awful lot going on there. So
Why don't we
leave it at that.
give the whole list a pass, Mark, and look at it again next month, okay?
So they're in the penalty box, but not thrown out of the game yet.
Okay.
All right. So with that in mind, let's go ahead and switch gears and go to our presentations. Ken is going to make a repeat selection of D.R. Horton.
Well, mine's going to be short and sweet, folks. D.R. Horton is America's home builder. It's the largest single home builder in the country. It builds under a number of different brands, and those brands are listed on this slide right here. Let's see if, I'm not moving the slides. Mark, will you get to the next slide, please?
I can do that for you.
D.R. Horton operates in all the light colored states, so a big swath in the upper west, a little bit in the plains and the Midwest, and it doesn't operate very much in New England or in some of the Northeast, but you can see that it has really nice distribution in a large part of the country. Next slide. Its consolidation and market share, it sells about little bit less than 9% of all the homes in the entire country. You can see the closings. You can see at the height of the housing boom in 2005, where it was moving houses, and you can see the steady increase in home sales again up through 2019. If we had one more bar, they haven't closed their books in 2020 yet, but if we get one more bar, then I'm sure that it'll be even higher than the 2019 bar. And as a percentage, like I said, they sell about 8.5%, 8.75% of all the homes in the country. Next slide, please. Their inventory is pretty nicely spaced throughout that map that I showed you. Here we have it broken down into sectors, and you can see that three of the sectors, the Southeast, the South Central, and the West sectors are pretty evenly split, 25% or so in each. Revenues match fairly closely the inventory. It's just an interesting idea that they're selling pretty much through all of their different geographies. Next slide, Mark. They sell lots of different styles of housings, from the very expensive houses, more than $500,000, to the starter homes from 0 to 200,000. I was interested to find out that the average home price in the country today is $331,000. So a great portion of this company is selling to the lower end of that market, maybe 2/3 to the lower end, with the other 1/3 going to the upper end of the market. Next slide, please. They also own 66% of a company called Forestar, ticker FOR. It's publicly traded. Forestar deals in land. They go in and buy the land and the contracts. They assume the debt for that land. They will do a little bit of making the land fit for building. That does not include, however, things like sewers and streets and that kind of stuff. They might go in and clear cut or do some grading, things like that. But for the most part, Forestar is a 66% owned subsidiary of D.H. Horton. Next slide. Here's the chronicle for Horton, and you can see the generally rising quality over the years until we have a quality that's in the 96th percentile right now. Very few times it moved down, but for the most part, that line has been, that's the blue line on the graph, by the way, it has been moving up. That 12.8 is still a pretty decent par value. When you look at the rest of the par values that exist, that's probably a par value that's above all the low marks, right about there. That's maybe a little bit higher because that's end of December, but I think that's a 13%. I think is a good return for this particular home builder. Next slide. I'm looking at Up Straight and Parallel. I'm looking at management that I think is doing a really nice job. That's a low debt rate for a home builder. If you look at home builders, look at 8 or 10 of them, you'll find that their debt ratios are usually much higher than that particular debt ratio. Good solid return on equity, although it might be pushed up by a little bit of that debt right there. And pre-tax profit, some of the best in the industry. Next slide, please. I use sales growth of 12, earnings growth of 13, PEs of 13.5 and 8.2 with a payout of 13.2. I'm getting 11.4. That's matching really closely the 12% or so that Manifest is saying. That validates my study as far as I'm concerned. I'm getting a buy at 3.1 to 1. I'm going to suggest another $1,000 into DH Horton. I really think that the demographics of this country, along with the Federal Reserve keeping of interest rates low for the foreseeable future, I really think that's going to lend itself to making home builders pretty profitable. And that's even with the headwinds of material costs that have been going up in a pretty substantial way, especially the cost of lumber. The increased cost of lumber for an average house, it's an extra $6,500 to $7,000 in lumber costs for the average house that's being built in the country today. Now, that seems like a lot of money until you remind yourself that the average home price is $333,000. So the materials cost is rising, but I think that the other things that are moving, including the very, very low, historically low interest rates, put the home builders in a very unique position for the next 4, 5, 6, 7 years as investments. That's enough, Mark.
Okay, thanks, Ken. All right, let's go ahead and transition into this. This is a stock where I believe that Kim may have an emotional attachment to this one. We try to avoid that, but this is one that's she's been pretty attached to for a few years. S&P Global.
Yes, I am guilty of that, Mark. Okay. As many of you may know me, S&P Global is a core stock holding as far as I'm concerned. I presented it in 2013 at $41.89, and then I presented it 3 years later, and it was $81. So you'd had a double in 3 years. That was 2015. This is 2021, and it's over $300 a share. It provides data, and there's a book that Mark and I have been talking on the bull session called The Myth of Capitalism. And S&P Global, in providing data, there's only like 3 other companies that provide data, so they're always able to raise the prices. So you never can go wrong with having one like that. You sleep very well at night, especially when they have a profit margin that's over 30%, and they have great growth, as well as they have a nice dividend. So I sleep really well at night with my core holding. Next slide.
I was just going to point out that we do miss the national conventions for the face-to-face moments, and that this looks like a ka-ching moment or a clink moment with Dolores there.
I think that's when she came to visit me here in South Florida.
Oh, there you go.
Yeah. This is from the latest value line. As you can see from 2013, this was a spinoff from McGraw-Hill Publishing. And what happened is they've just gone straight up because this spinoff, you had two different divisions. You had books from schoolwork and financial data, kind of an odd combination, so they spun it off. They're going to, they've got more profitability to get, and they are going to reduce their spending, and they've got target areas to on real estate, infrastructure, IT infrastructure, and travel. The other thing that's really interesting about this stock, within the last month, they have announced that they're going to buy IHS Information Services. And I'm not very concerned about it because they're tacking on some debt for this, but they have, I think, $3 billion of free cash flow a year, as well as the administration and management company of S&P Global will be running 4 of the 5 offices. And if you look at the profitability and the research return on invested capital of S&P Global compared to IHS, hands down, you want it to be the S&P Global people. So this is a stock that would be a core I think everybody should put on their watch list. And if it ever has a pullback of 20%, make sure you go take a look at it. Next slide. And so now this is my non-core holding presentation. And along the theme of what Ken presented, I found that my library services has got a special situation newsletter that I get through my library. And they were saying that I should take a look at IBP, which is Installed Building Products. And they are a building company that have got different divisions all over the United States, but their consumer construction business was 18% and multifamily was up 12%. Now their number one clear breadwinner in their area is 64% is insulation. And think about how many new homes are getting built, like Ken said, and new businesses that they can get insulation on those walls. They also have waterproofing. They install shower doors, shelving, mirrors, garage doors, rain gutters, window blinds, and all that. Next slide. Here is what we got as to what they look like with the value line. Overall, the special newsletter, special situations newsletters feel that ultimately, and this was as of the January value line article, said that they felt that this price target in 5 years could be 190, and it's at 109 now. So we could easily get our 15% return a year. They have many, this is a serial acquirer. Now they have quite a bit of debt if you'll look at it, but the thing is they are vertically integrating all these acquisitions together so they can cross-sell to everybody, and that is also helping their bottom line and their cash flow. They believe that their growth could grow over 10% going forward, and earnings per share up to 20%. The newsletter, I will send the value line special situations. Mark, can you post that if I send that to you?
Yeah, I might have to excerpt it a little bit, but we can.
Okay, I'll send that to you so everyone can take a look at it, but this would be my suggestion because I'm kind of riding on the back of what Ken talked about, but this is a housing play, like Ken said, and one of the things I learned from one of the books I read called Investing with the Fed is that when the Fed keeps interest rates down, home builders, RVs, jet skis, all those things that have those long-term payments that people have to do and interest rates are low, those areas really do quite well. So this is a stock that I was presenting tonight.
You know, one of the things I think might be an interesting look from an educational standpoint is Tom O'Hara used to talk about buying Corning glassware and not trying to decide which television company was going to win. And why not buy the glassware company that sold the tubes to all of them? It would be interesting to see who the customer list for installed building products is. And if it includes D.R. Horton and who else it might include. Who do they sell stuff to?
It's interesting. But when the article from Value Line, they really didn't say who their customers were.
Mm-hmm. All right. You good to go then?
Yep, I'm good to go. Moo.
All right. I really liked my picture from New Zealand last month, so I kept it for no particular reason other than I just liked the scenery. Last month I presented A2 Milk Company. It's gone down a little bit, but I still like the concept. I did visit a couple grocery stores over the last month, and I now see it on the shelves. It was always there. I just didn't see it. It's out there, and I would just encourage everybody to become more familiar with A2 milk versus A1 milk.
Mark, we actually bought a half gallon of it, and just to try it out, and it tastes like, believe it or not, milk.
Well, that's a good thing. All right. Well, this afternoon at the bull session, it is coming down to that time of year when we have our Groundhog annual stock selection contest that runs from February 2nd to February 2nd every year. And this afternoon, we shared a bunch of screening results. I'm going to steal a couple of those and share them with you, and also invite you, if you are interested, to take a look at some of the shopping that is going on, and invite you to participate in the contest itself. More on that to follow here, but we basically went through a number of screening techniques, including Hugh's Irish Spring, where he likes to shop near 52-week lows. Kurt's, every year Kurt enters the Groundhog contest, and he literally spends, it says 5 minutes there, but he doesn't spend 5 minutes. It's like 2 minutes a year. And he's up 18.3% per year over the last 10 years or so. Not too shabby. But the one I want to concentrate on here is one that has been so kind and rewarding to us. This is the triple play put forth by George Nicholson. And that's going to form the basis of my stock selection for tonight. The screening candidates that are on this screen all have the characteristic of having the combination of all three elements of the triple play, that being an elevated return forecast because of a depressed stock price, hopefully temporarily depressed stock price, the opportunity for margin enhancement, better profitability going forward, and last but not least, an opportunity for PE expansion potential. And the companies on here are likely to have, I went through and looked at most of them, just doing a quick look at the value line pages, and most of them seem to qualify fairly well. And it's up to you to apply the filters and take a closer look. But right at the top of the list is a selection that Ken had made and was seconded by the audience a little over a year ago, Alimentation Couche-Tard. The ticker is ATD.B.TO, traded on the Toronto Exchange. There is an American ADR. That ticker escapes me, but maybe somebody can look it up, and we can provide that later. But it just basically came across as one of the better selections. Alimentation Couche-Tard qualifies for the triple play. Again, the three elements are high return potential. So we see elevated return forecasts here in the projection box, the long-term 3 to 5 year projection box. We also see quite a gap between the value line, and the stock price. So that's basically condition one of the triple play. The next condition is to notice that the current PE is running, somewhere in that 11, 12. Down here you see a 13 for 2019, somewhere in that just a little bit into double digits. And if you look over on the far right, the value line analyst believes that a PE of 16 is feasible for this company. So that meets the second of the three criteria. Now, the profitability, you could look at different levels of profitability. We'll just look at the net profit margin. Current values are running in that 4 to 5 range. with the potential to go up into the 7 to 8% range in the future. I happen to think that's a little bit ambitious, but the opportunity is there for that potential. So it has all three elements of that. One of the other screens that we looked at this afternoon, and I'm not going to go too deep into it other than to just provide it here for you tonight, is our projected return on value screen, where I limited the field to excellent quality companies that rank in the top 20% with respect to quality, and then I wanted double-digit projected return on value that you see here in this column. Okay? And Alimentation Couche-Tard actually ends up in that field. So that's what we're going to go after. Now, again, just to reiterate, this is basically I'm trying to live in the past, maybe jump in the time capsule and go back and correct an error I made many years ago when I didn't invest in Casey's General Stores 15 to 20 years ago. What these guys are the Circle K company that you see all throughout, mostly in the Midwest and the South, but pretty much throughout the United States. Although based in Canada, they do have quite a footprint with the Circle K convenience stores and gas stations all around the country. So that's who these guys are. And so you see a pretty decent projected return, good quality, good projected return on value. The average value for that right now is about 5.5%. You can see that Value Line has high expectations. And again, the analysts, either at Morningstar or the analyst consensus, think the company's on sale and a pretty good kicker in terms of expectations over the next year. We have been really kicking around this projected return on value concept during our bull sessions and at a few of these sessions. And we just encourage you to become more familiar with what it entails. We believe that it's basically is an opportunity to tighten up some of the stuff that we do. Here's a look at the company's business model from top to bottom. You can see that it has been a little bit bumpy, but there are some divestitures in here. But over the long term, the trend is up and to the right and in mid-single digits with respect to a growth rate. Earnings have actually been pretty good, and they're projected to head north, if you will. So we're looking at a company, roughly a $70 billion company with a growth rate of, I'm going to go ahead and use 4%. That is the slope of this line, 4%. And a projected net margin of about 7%, which, again, is fairly easy to bite off on looking at that management output of profitability over the years. The PE ratio, you could go somewhere in the mid-teens. 15 works for me. Under that set of assumptions, we're looking at a return forecast of 16.5%. Not bad, considering that the average stock right now is running at about 5%. So the projected return on value, again, that's down around 5%. 13.7 places it amongst the leading companies. Decent effective interest rate on the situation. Pretty good expectations according to Value Line. One of the things going on at the company is they had expressed interest in acquiring a European company out of France known as Carrefour, a bunch of convenience stores in Europe, and that transaction has essentially fallen through. I don't know if it's completely fallen through, but Wall Street didn't care for them even making the effort, apparently. And that has a lot to do with where the price has gone in the last couple of weeks. So it was $44 a couple of weeks ago. It's now $38, $39. And a part of that is the punishment over the confusion and uncomfortable nature of the situation, at least according to the institutional analysts that follow the company. So good return forecast, very high quality company in a realm that has plenty of opportunity. And it's always good to have some investments in things that we eat or sit on and that sort of thing. So I'm going to go ahead and accumulate another $1,000 into Alimentation Couche-Tard for the portfolio. Just a quick note that we do archive all of these presentations on YouTube before we go to the poll. If you just search on Manifest Investing, you can find all of the old sessions, including our Successful Investing 2 COVID cancellation conference back in November. There's another one in May, but notice that all the roundtables are here too. So if you're interested, take a look at YouTube. We'd love to have you, and you can catch up on some of the stuff. A lot of the discussions that we were talking about in the green room have been going on in these. If you can't make Tuesday afternoons, we invite you to check out some of those to see some of the stuff we've been kicking around. So with that, Ken, I think we can go ahead and go for the poll.
We'd love for all of you to take a time to vote. If you have a touch screen, you can use the touch screen, or you can use your mouse, or you can use your touchpad. We'd love to get 85 or 90% of your voting. We just passed 80%. Let's see if we can get 8 or 9 more of you to vote. I'm going to count to 10 and then close the poll. Oh, that brought in 3 more. Come on, let's vote just a little bit. 2 more people, and we can hit in there. We hit 90, and I'm going to close the poll, okay? And I'm going to share it. And it looks like DR Horton took the race at 39%. Installed building products at 30%, and Alimentation Couche-Tard at 26%. 4% of you didn't like any of them, so we'll have to have you come and make a presentation next month.
So clearly not a majority, right?
Not a majority this time, no. No.
Okay. All right.
I'm going to hide the poll and let you continue, Mark.
All right, we mentioned the Groundhog Challenge, and again, I just dangled this out there.
Mark, I need to explain to a couple of different people. Kim presented S&P Global for interest. She did not feel it was a buy, and she did not feel it was something that we should purchase at the present time. It was just there for an interest. So that's why S&P Global did not appear on the poll.
People wanted to do a write-in on S&P Global?
Evidently. All right.
Makes sense. It's a fascinating company, and as that stock price showed, if it does back up a little bit more, it could get very interesting. Probably not as attractive as the 3 companies that were presented, at least on a return forecast basis. All right. So again, just wanted to extend the invitation and make it clear to everybody that you're welcome to participate. Your quote lives in infamy there. Patience is genius in disguise, up at the top of the chart.
Excellent.
I can let you go ahead and you guys can all read. Basically, you pick 5 stocks up to a maximum of 20, but I'll tell you, it's I don't think we've ever had a winner with 20 selections, and it's probably a higher probability of winning with the 5 stock portfolio, because when you hit it big on one of them, it really can be rewarding. So you can enter as individuals or as groups. Many people, like Ken, enters individually, and then on behalf of his 19 investment clubs that he participates in. So he gets in there a few times. He's actually in 4. He asks that I reduced the number from 19. I think he used to be in 19, and now he's down to 4. So again, you're most welcome. You can send me the tickers at markr@manifestinvesting.com, and we create special dashboards and all that kind of stuff. So consider that. Ken, do you want to talk about our company?
Mark, could you go back a slide, Mark?
Mm-hmm.
Kay is an old eagle eye here, Kay Light, and she's noticing in number 5 on your rules of engagement that February 3rd is actually Wednesday.
Oh, well, I'll fix that. going forward.
Okay, so
Let me take care of that for Kay right now.
instead of having until this coming Monday, folks, you actually have until a week from tomorrow to submit your groundhog entries.
Bad calendar day. All right. Thanks, Kay.
You can put, and we're getting clarification. You can put your groundhog on the forum if you want to. You can send it as an email to Mark. As long as it's clearly stated what it is and where it is, Mark will be able to get it and put it into the contest.
Yeah, it's run fairly well, and it's our 15th year of doing it, so fairly straightforward. We will be out with our results next week. We pay as much attention to the 15-year results as to the single-year results, but we do have a lot of fun with it. And it is a source of ideas, and it's something that Ken and I have talked about quite a bit, that you guys are a wonderful source of ideas. All right, coming attractions. Again, just a reminder that we do have the bull sessions on Tuesdays, and we do have the YouTube archived recordings. If that doesn't work for you at that time of day, we do have some fun kicking around topics. February Roundtable, I believe that's the correct date, Ken, February 23rd, last Tuesday in February. And that is our annual awards program with the Golden Knight statues. So we'll have some fun with that. We are going to do an e-conference with Indianapolis on March 27th, 2021, and we will be adding some other programs to this roster, hopefully fairly soon. Give you guys some lead time awareness of them. Anything else you need to add to that, Ken?
No, I think we're doing okay for the moment.
All right. In honor of the bull sessions, we put the bull on the beach. Kim's place could be just around the corner from the beach there. And Bernie's not dressed appropriately for that picture, but hey, he's working. And then a reminder that, yeah, next month we do have a lot of fun at the session. It's legend. I'm not sure how much truth there is to it, but Hugh McManus has been known to show up with a wheelbarrow for his trophies over the years. This year he didn't have quite as good a year, but he's got quite a track record. 2 or 3 years ago, Kim took home every award, so we didn't invite her back the next year. But Kim had quite the formidable year a couple years ago. We just have a lot of fun with what have the best ideas been, short and long term, here at the round table, and it is done for the purposes of some good fun. So with that, Ken, I think we can go ahead and shut down officially. Stick around and talk about crazy stock activity if you want, or anything else that is on people's minds.
Well, I have some questions in the question box, Mark, and I have some hands that are raised. So if you want to shut down, I'll go to some hands real quickly.
All right. Thanks, everybody, and we will go ahead and continue in the, all the shows like on HBO. What do they call it? Like after session or something? We're gonna do that.